Pets.com burned millions while selling dog food at a loss. What began as a humble spin-off from WebMagic quickly ignited the imaginations of investors in the late 90s tech frenzy. Pets.com entered the scene in November 1998, driven by an ambitious promise of revolutionizing how Americans bought pet supplies. Despite its unproven business model, Amazon.com spotted potential in this nascent venture. By early 1999, Julie Wainwright had helmed the company, and with her arrival came a pivotal move. Amazon, alongside Hummer Winblad Venture Partners and Bowman Capital Management, injected $10.5 million into Pets.com, securing a majority stake. The endorsement from Amazon was seen as a celestial endorsement. Wainwright herself proclaimed it as a marriage made in heaven. With Amazon's backing, Pets.com embarked on an aggressive expansion, sinking funds into warehouses and infrastructure, even absorbing its primary competitor, Petstore.com, for a cool $10.6 million. Yet behind the glossy marketing campaigns featuring the beloved sock puppet mascot, a storm was brewing. The company lacked a sustainable plan, selling products below cost, hoping sheer volume would eventually turn the tide. As sales soared, profitability remained elusive. The clock ticked ominously as Pets.com raced to outpace its losses, unaware of the seismic shifts looming on the horizon. Would the dot-com darling find its footing, or was it already teetering on the brink of collapse? Propelled it into the cultural zeitgeist. This unassuming puppet, with its bug-eyed charm and quirky antics, became the face of a marketing blitz that sought to capture not just customers, but the very spirit of the burgeoning internet age. With each appearance, from the sidewalks of New York during the Macy's Thanksgiving Day Parade to the coveted commercial slot in the Super Bowl, the sock puppet transcended its role as a mere advertising tool. It became an icon, a symbol of Pets.com's audacious attempt to carve out a dominant niche in the online retail space. As Michael Ian Black lent his voice to the character, the puppet's witty persona and endearing antics struck a chord with audiences nationwide. But behind this facade of success, a darker reality loomed. The aggressive marketing campaigns, while raising awareness, also bled the company of critical resources. Despite soaring sales figures, the financial viability of Pets.com remained in peril. The sock puppet, for all its success, was a beacon of a brand on a precarious path. As the puppet waved to the crowds, the question lingered. Could Pets.com sustain its meteoric rise? Or was it destined to unravel as swiftly as it had risen? The marketing campaign was nothing short of audacious. Amidst the dot-com gold rush, Pets.com bet the farm on one simple principle: visibility equals viability. The sock puppet mascot was everywhere: television spots, magazine covers, and even atop a float in the Macy's Thanksgiving Day Parade. Yet behind the curtain of this theatrical blitz, a critical piece was missing: market research. As the company poured millions into eye-catching ads, the assumption was that brand recognition would automatically translate to profitability. But without a thorough understanding of consumer needs or the competitive landscape, they were flying blind. The Super Bowl ad, costing a staggering $1.2 million, landed Pets.com in the spotlight. However, the spike in sales was an illusion, masking the underlying truth. Products were being sold at a loss. With each advertisement, each parade appearance, the question of sustainability loomed larger. They had built a brand persona adored by the public, but the financial foundation was crumbling. Unbeknownst to many, beneath the charismatic surface, Pets.com was hemorrhaging funds at an unsustainable rate. As the sock puppet danced across screens, internal alarms were sounding, desperate to be heard. Would the allure of the brand be enough to stave off disaster, or was Pets.com already on a collision course with its fate? Was sold on the website. But beneath the puppet's cheerful exterior, a harsh reality lurked. Pets.com's business model was fundamentally broken, a glaring contradiction between its public success and private turmoil. The company sold products at steep discounts, often below cost, attempting to capture the market with tantalizing offers. Yet this was a disaster in the making. Each sale bled more red ink into their financial statements. The more they sold, the deeper the financial chasm grew. Shipping was free, a decision that shredded already razor-thin margins. Heavy items like cat litter and pet food devoured profits, as those very costs spiraled beyond control. Despite the celebrity of their sock puppet and the flood of venture capital, profit was elusive, a mirage on the horizon. The hope was that burgeoning sales would someday justify the losses, that customers might shift towards more profitable products. But that shift never came. Consumer habits proved stubborn, unyielding, and by their second fiscal year, the company continued to sell goods for 27% under cost. While sales figures soared, they inadvertently hastened Pets.com's demise. The customer base expanded, yet the financial losses only deepened. The clock was ticking, and behind the facade of a booming brand, reality was about to unravel. What awaited as the numbers tightened their grip? February 2000, the excitement was palpable as Pets.com entered the NASDAQ, raising a staggering $82.5 million. Its iconic sock puppet starred in a high-profile Super Bowl ad, reaching millions. Yet beneath the razzle-dazzle, cracks were showing. The company's foundation was built on a precarious blend of massive marketing spends and unsustainable discounts that barely covered costs. By the time the stock debuted, Pets.com was already losing money on every sale, selling products for far less than their purchase price. Fueled by aggressive marketing, their sales figures climbed, but the bottom line remained elusive. The very tactics that brought visibility also hastened their downfall. No independent market research had validated the viability of their strategy, leaving Pets.com exposed to the harsh realities of the low-margin pet supply market. As the dot-com bubble began to waver, investors grew wary. The stock price, once buoyed by novelty and hype, began its plummet. Market confidence eroded swiftly, and the rush of enthusiasm gave way to the chill of financial loss. Investors watched in disbelief as Pets.com shares, once $11 apiece, spiraled to mere cents. The stage was set for a reckoning. With mounting pressures and a cash burn that was impossible to sustain, the countdown to disaster had begun. What would the final act reveal? In a desperate bid to stave off the inevitable, Pets.com pinned its hopes on a radical strategy. They relocated significant operations to a new customer service call center in Greenwood, Indiana. This move, a last-ditch effort to slash overhead, was accompanied by a flurry of attempts to secure a lifeline through acquisition. Yet, as the clock ticked down, even PetSmart's offer, paltry and less than the company's net cash, was refused. This decision, marked by a refusal to concede defeat, would prove futile. By November 7, 2000, the grim reality set in. Pets.com announced it would cease operations mere days later. Amidst the turmoil, 255 employees were let go, the hopes of hundreds of thousands of customers extinguished in a moment. Yet not all would be lost to the annals of history. Some assets, including the now iconic sock puppet mascot, would find a new home. As the last orders were processed and the servers went dark, a question lingered. Could the lessons of Pets.com's rise and rapid fall be a warning for the next wave of tech dreamers? As the digital landscape continued to evolve, the closure of Pets.com in November 2000 marked a critical juncture in the dot-com saga. With its stock plummeting to a mere 19 cents, the announcement of its shutdown sent shockwaves through the industry. Hundreds were laid off, and the scramble to liquidate assets began in earnest. The much-publicized sock puppet mascot and the millions spent on a high-profile marketing blitz were not enough to mask the fundamental flaws in the business model. Pets.com had launched with fanfare, its presence bolstered by a memorable Super Bowl ad and a prominent float in the Macy's Thanksgiving Day Parade. Yet, beneath the surface, the company was hemorrhaging money, selling products at a loss and struggling to sustain the expensive logistical framework it had built. By the time the stockholders met in January 2001, the company was a shell of its once ambitious vision. The assets, including the domain and brand, were sold off to PetSmart, a haunting echo of what could have been. The story of Pets.com stands as a stark reminder of how quickly fortunes can change in the volatile world of tech and e-commerce. But in the ashes of its collapse, a question loomed large. What would become of the digital pioneers who dared to dream big? Pets.com may have vanished from the digital landscape, but its impact lingers, a symbol of the dot-com era's reckless ambition and spectacular failure. The infamous sock puppet, once a cultural phenomenon, now serves as a reminder of how quickly hype can balloon into catastrophe. Despite its demise, the remnants of Pets.com found new life. Its domain, Now a path leading to PetSmart reflects a tale of adaptation and survival amid collapse. As the dust settled, Pets.com became a case study, its rise and fall dissected in business schools and boardrooms alike. It warned of the perils of unchecked growth and the dangers of prioritizing brand recognition over profitability. Yet its story also highlighted the relentless drive of the digital age, a drive that pushes the boundaries of what's possible, for better or for worse. With every redirect to PetSmart, the legacy of Pets.com persists, subtly influencing the strategies of e-commerce giants that followed. Its dramatic fall serves as a cautionary tale, but it also raises a poignant question. In our pursuit of innovation, how do we balance the dream of a digital future with the realities of sustainable business?